everybody. Previously, we were discussing about financing an enterprise and starting up what are the legal formalities, then IPRs, about sourcing of finances, everything. Now we'll be discussing about the capital structure today. So recap sources of finance. We were discussing internal source and external source, everything. Now in this session, we'll be discussing about capital structure, term loans, and type of term finances. So capital structure refers to the mix of debt and equity that a company uses to finance its operation and growth. It represents the proportion of various funding sources in a company's overall financial structure. The key components of a capital structure includes its equity and its debt. So equity is of two types: common stock. It refers to represents ownership in the company, typically with the voting right, preferred stock, providing a fixed dividend, and has providing over common stock in asset distribution during liquidation. So retained earnings is discussing about the profits reinvestment in the business rather than distributing as dividend. Okay, so debt is of two types: long term and short term. Long term debt or bond is represent period extending for more than 1 year, and short term debt organized due to the within 1 year, such as bank overdraft or commercial papers and other things. The importance of capital structure: it enables an organization to frame a cost of capital. It optimal capital structure minimizes the cost of capital and maximizes firm's value. Then secondly, when we talk about is risk management, a balanced structure helps in managing financial risk associated with debt and obligations. So he has to plan what is to be invested and how he is going to repay it. So financial flexibility, so he could determine the company's ability to raise funds and invest in an opportunity than getting orders and getting a black mark. He could see the financial flexibility and determine what is his position in the market. Then shareholder value, so impact earning per share and shareholders return has to be planned properly. Key consideration in determining capital structure is business risk, market condition, control consideration, and financial strategy. Other aspect that we have to see. So what is term loan? Term loan is a type of loan offered by the financial with a specific repayment schedule and a fixed or variable interest. These loans are typically used to financing significant expenditures such as purchasing equipment, real estate, or other fixed asset, and paid back over a set of period that is specified by the the fund who is going, the organization who is raising a fund and giving it to you. So fixed duration repayment occurs over a permanent period, usually ranging from 1 to 10 years or more. So interest rates can be fixed or variable depending on the lender's term. So he is the person who has to organize and tell you what happens and when is the time duration. Then purpose is often used for business expansion, buying equipments, or other long-term investments is also applicable here. Repayment is usually through monthly, quarterly, or yearly installments. We have to pay it back. Collateral is many term loans require collateral such as your asset or property papers or equivalent to secure the loan. Anything, mortgages of jewelry or anything that they take it as collateral. Types of term loans are short term loan, medium term loan, and long term loan. So this is all about when we talk about advantages, it is predictable repayment schedule can be customized based on the business cash flow. Often lower interest rates are seen here compared to the credit lines. And disadvantage when we see here is collateral request can poses a risk. Fixed repayment can strain cash flow during low revenue period, and there may be a risk of losing the property. So conclusion is finance play a vital role in the managing resource driven growth and promotional economic development. As finance continues to evolve, it's essential to stay informed about the latest trends, technologies, and innovation shaping the industry. So So before starting up a venture, we have to plan our finance, the sources of finance and everything, how we are organizing and how we are using it, and what is the way that we are going to pay it back. You have to plan everything. That is why finance is very important in framing up a business. So knowledge check, a type of revolution credit. What is the term loan? Type of revolution credit, a loan with a fixed interest rate and repayment term. So it is fixed replacement and thank you for giving me an opportunity. Thank you. Hope you enjoy this session, guys.